All right, let's get started. Hi, everyone. Welcome to the webinar. I'm Zach. Um, if you haven't gotten a chance to watch the first webinar I did, it was about footprints. This webinar will be an extension of that, not specifically just footprints, but the theory behind them. There's been a lot of conversation between Avi and I, especially in the happy hour, um, about whether or not footprints are the most ideal way of viewing this information. And it's a good discussion. Um, we like to talk about 80/20 here. And it got me thinking, is footprints the most 80/20, the most efficient way of viewing order flow data? Or is there a more efficient way? I asked myself this question and I started thinking, what are the tools that I'm using myself to view order flow information? So I wanted to make a webinar regarding that, the different types of tools I use and how I interpret the information across them, which, spoiler, they are the information, the interpretation of it is the exact same across the tools. So we'll get into it. I called it Order Flow Part 2, the same flow with a new view. Here's the roadmap for what we'll discuss. This will be a rebrief of what we discussed in the first webinar, same as this. I'll go over the types of liquidity you'll see in markets and then the types of order flow you want to pay attention to as a day trader. Then I'll talk about the different types of views you can use for order flow. So what that means is the different tools. There's footprints, delta profiles, and CVD bars. And then we'll go over some examples and do a bit of Q&A. All right, so the different types of participants in markets. This is the first thing that needs to be discussed because it is quite important. There's two types of participants that you need to concern yourself with. Number one is passive participants. Passive participants are people who are on the bid or on the ask. They're passively waiting for their orders to get filled. So when you're looking at a depth of market, a level 2 book map, um, you're viewing passive liquidity. And then there's the second type of liquidity, which is aggressive liquidity. These are market orders. I want you to think people playing breakouts, playing extension moves, having urgency to try and get into the market. Traditionally, market orders are viewed through the tape, aka the time and sales. Now, as futures especially get more popular, more tools are coming out which are more efficient, and we'll talk about those. It's important to understand that for passive liquidity to get filled, you need aggressive liquidity. These two work in tandem, they work hand in hand. So you need both. Both are present at all times in the market. Now we'll talk about the different types of order flow you need to concern yourself with as a day trader. This is simple. People complicate it. They, turn it into a bunch of different things, but really it's this. It's continuation, which is essentially when the market is continuing, trending, going in one direction. And then there's absorption. Absorption, aka stopping, reversing, that type of stuff. All right, so continuation is when market orders are overwhelming the passive liquidity. So let's say there's a bunch of sellers. Now I have a screenshot of Bookmap right here. Let's say there's a bunch of passive liquidity in the market right here. Now these are people sitting on limit orders on the ask. They're not urgently trying to get into the market. For these orders to be filled, when price comes here, someone has to press sell at ask, buy at ask, press the market order button to initiate this passive liquidity. Now this passive liquidity, you can think of it as kind of like a wall, and as price is moving up, it's going to hit this wall and struggle to get through or pop right through if there's enough liquidity. Your job as an order flow trader is to understand who is winning this battle, the passive participants or the aggressive participants. So let's go back to this slide. When you're seeing continuation, the market orders, so the aggressive participants, are overwhelming the passive participants. You'll hear oftentimes in markets, buyers lifting the offer, sellers hitting the bid, there's urgency, there's little resistance to the top side, and if you're an auction theory player, you play market structure, Wyckoff, that stuff, it's expansion, it's breakout price action. And then there's absorption. This is the really fun one. This is when there's too much passive liquidity. Uh, one thing that isn't spoken enough about in markets is that large participants, not you and I who are buying 10, 20 contracts. What I mean is like people buying institutions, buying thousands, tens of thousands of contracts. They do not really enter and enter positions on market. They enter via passive liquidity. So they are that big wall you're seeing. And as price is going into it, as we say, there's the smart money and the dumb money. The dumb money is buying into the smart sellers who are getting the best price, right? This is absorption. So in absorption, price is not advancing. It often creates rotations. And this is where the concept of trapped buyers and sellers comes in. I discussed this more in depth in the first one. That's why I'm going over it quite quickly. But if anyone wants me to, expand on this, I can. I like to think of it like this. There's someone with a tool and they're trying to break the concrete, and the concrete, I want you to think of that as the passive liquidity, as the limit orders, and you're trying to see what's stronger, the hammer or the concrete. That's your job as an order flow trader. And then you use tools to decipher that information. Okay, so in the first webinar, I talked about footprints specifically, and that is not the only tool I use to decipher order flow information. It just depends on your preference of what you prefer to look at, how your brain works, all that, to decide which tool you use. No matter which tool you use, the order flow analysis and the concepts are the exact same. So I'm going to show you 3 different tools, and the concepts that you're going to apply to them are the exact same. You just have to decide which tool you prefer using. The goal of order flow analysis is to observe the battle between buyers and sellers at key levels. Again, concepts over tools, context over signals. You want order flow to be something that paints a picture for you. Price action is telling you one thing, and order flow will either confirm or deny that. And then you want to find what resonates with you, which tool works best for your brain. I put a picture of the floor traders back on Wall Street back in the day, and they also used to use order flow, but they used a different tool. The tool they used was their ears. Back when people were trading on the floor, you could hear the liquidity. You could hear people selling. You could hear people buying. You could hear people panicking. You could hear people being passive. How you would hear this is how loud the room got, how quiet it got. This was a form of order flow analysis. And as the floor, became redundant, basically, thanks to electronic trading, these guys really struggled to transition to electronic trading. Why did they struggle? Because their brains resonated with the type of order flow analysis that came from listening to people buying and selling. So just like these guys have their preference, you have to develop your own preference, and that's what these tools help you do. So let's look at the different types of tools. First of all, the footprint. Very basic. We've gone over this before, and I'm sure Avi has done a great job at explaining this stuff to you guys. So we won't go over this too much, but basically when you're looking at a footprint, you're seeing only market orders. you're only seeing market orders, and you're seeing what the delta is. This is a delta footprint specifically. Delta is the difference between buy and sell. So let's say there's 100 buyers and 50 sellers. 100 plus minus 50, right, equals a delta of 50. Or you could have minus 100 buyers and plus 50 buyers. Now you have a delta of minus 50. Delta is just the difference between the market orders. And a footprint allows you to see that at every specific price interval. Now, how you can interpret this information at each price interval gives you edge. And if you have other ideas, levels, etc., at these zones, it helps you build a picture for what's really going on. So footprints are a great tool for viewing this stuff. Traditionally, footprints are minute or range based or tick based. So essentially, a new candle prints every time a minute passes or 10 ticks are traded or whatever your interval is, but they're candlesticks. That's what footprints are with just internal data. The next tool I'll show you after this is not a candlestick, but it shows the same information. I wanted to show an example of continuation. Continuation on a footprint is very clear and simple to see. Continuation looks like price moving directionally. So here it's all moving down. And as price makes new lows in this example, it could be making new highs in a trending example. As it's making the new relative low, you're seeing continuation of intention from buyers or sellers, whoever's controlling it. So in this one, in continuation to downtrends, every time there's new lows being made, you want to see more sellers, more sellers. That's just showing you intention. They're willing to sell lower and lower and lower. They're not getting exhausted. Volume will be building, and then price in this context, if you use Wyckoff and market structure, this will be in expansion, aka range breakout modes. This is where you'll most likely see this type of order flow analysis. So you want to be able to pair this information with your price action analysis. Here's an example of absorption. Now this is where it kind of gets fun. Absorption is traps. So like we talked about in this slide, absorption, it's when passive liquidity is too large. So this is the passive liquidity, right? As price is going up, I want you to think, if this is a level for some reason you think is a sell level for you, right? You want to layer this again, and price trades up to that, and you're seeing buying come in, but the buyers are not being rewarded. So in this example, you can see we got a bunch of new buyers at the high, but price did not continue higher. Instead, it gave us a doji candle like this. The following candles, you'll notice, have a lot of the inverse of this. So what does that mean? If you imagine the story being told to you, buyers are continuing to buy up, continuing to buy up. They're buying at this level and price doesn't move. What does that mean? There's a bunch of passive liquidity. Passive liquidity is overwhelming them. And eventually, if you are a buyer, to exit your position, you have to become a seller. You have to become your worst enemy. That sell pressure, that trap, in other words, it's called trapped buyers, trapped sellers. In this context, it's trapped buyers. Their exit liquidity will be what initiates the move down, and the passive liquidity trapping them is what causes the stop. So yeah, buyers are present at highs. There is no continuation. Passive sellers will overwhelm aggressive buyers, and usually price is in a rotational phase. Okay, so now let's talk about tool 2. As I was saying about footprints, they're candlesticks, right? However you want to measure the candlestick or configure it. There, it's a candlestick. Now, sometimes candlesticks are not the most efficient way of seeing this information because, as we know, markets are not, they're not going to go up and then just hit a level and instantly tank down. Happens sometimes, but for most of the time, markets will balance out before they expand down. What a delta profile, so this is the second tool, a delta profile, what it shows you is delta, the difference between net buying and net selling at each price point. So let's say this price point is $1. This price point is $2. That's 3. That's 4. That's 5, and everything in between. What this tells you is for all the data that's being populated here, what the net buying was at this price point, what the net buying or selling, what the delta was at this price point, that price point, etc. So this allows you to get an analysis of the zone rather than exactly one price. I prefer this especially around higher time frame levels because higher time frame levels, they tend to consolidate a bit before they go, so you can see the building of large positions. I also believe this is a better tool because, frankly put, large institutions are buying tens of thousands of shares and they cannot get filled in one candle. They need to accumulate their positions. So they're building short positions throughout this whole thing, trying to take it down. And you can see all of that happening. Now you get to build biases, and as a day trader, you can lean on these zones for better R to R to play it down. Plus, you have internal data helping you build your bias. Plus, you have some type of uh, trade strategy, Fibonacci, whatever going on top of that. So it'll show you, delta profiles will show you order flow of the entire visible range. They're designed to be plotted only at key areas, and they allow for the aggregation of data. This is important. Um, we know that futures, especially ES and NQ, they operate in intervals of quarters every 25 cents, right? It's 25, 50, 75, etc., right? Now, since these, like I was saying, since these institutions are so large, they don't care about little tick intervals. We need to get that out of our heads. They don't operate like that. They operate in bulk, in batches. So viewing price, especially in futures, at one little tick interval is useless. You want to see the aggregation. I usually aggregate my delta profiles to show me an entire point, sometimes even two. So that means 0.25, 0.50, 0.75, and the full dollar. All of it has its own delta, and what a delta profile will do is it'll aggregate this to show all into one bar. So let's say it's 5 for this price point, 2, 3, and another 5. That's 15. This will show as 15 in a delta profile. You can aggregate it. So now you're not, losing your mind over little tiny price points when futures operate in zones. Okay, so that's a delta profile. Here's an example of a delta profile absorption. This is from yesterday, I believe, or the day before. As you can see, it's very clear. You plot this profile, and as price moves up and down, each one of these continues to populate based on what information is being portrayed to you. With just a footprint, you're only going to be seeing price here or here, but it doesn't help you build a bias, right, relative to the whole zone. Delta profiles help you with that. This is a great example of absorption right here. So passive liquidity, reversal price action. So what does this mean? Absorption, again, price is moving down. Price is moving down. It hits this level. There's a bunch of aggressive selling, but there's no reward for this selling. So when you're not rewarded in your position, eventually you have to exit, and your exits create a squeeze, which create breaks. So you can see that in the entire zone and play either here, or you can play here, or here, or here, based on whatever strategy you define, but it helps you build a bias relative to that. So breakout players are getting no follow through. They must eventually exit their positions. Again, passive liquidity is overwhelming the aggressive liquidity, and it is showing you the exact same signals as a footprint. It's just represented in a cleaner fashion. Here's an example of continuation. Now, this example of continuation and on the footprint and this example of continuation on the delta profile, again, it's the exact same concept. As price is moving up, you want to see every price interval more buying coming in and price structure confirming that buying. Order flow alone can get very tricky. You want price action plus order flow. It's not entirely it's not really efficient to use order flow alone, but I'll talk about that in a little bit. So continuation, you can clearly see as we continue to make new highs, every time you make a new high, press, press, press. This is confirmation of your trade continuing to go. Here the candle structure and the order flow are in alignment, and if a new low is made, it doesn't have any selling tied to it. So another great use of this is, let's say we're going up, you're seeing the buying, and as you go down one or two candles, the relative selling is just tiny compared to the relative buying. So it helps you stay in trades longer. Another great thing about delta profiles is most programs allow you to select where you plot it from. So you can start at the pivot and then continue out, or you can only view it in this area if you find that important to get you closer to the purest information of that price zone. The third tool is CVD bars. Now this is an interesting one. I would say that this is the most 80-20 order flow tool. The reason I say that is because it represents the information in the cleanest way from my personal perspective. This right here is a candlestick chart, and underneath that, where some people have like volume sticks and all that, I have CVD. CVD is cumulative volume delta, so it's just delta. It shows the delta battle between buyers and sellers as a candlestick chart. So just like if price opens here and then it goes up a bit, comes down, goes up, eventually closes here, and there was a little wick, a candlestick populates like that. For delta, it does the exact same. So if delta was rising and then it fell a bit, but then it rose and then it closed here, it'll populate a candlestick that looks like that, right? So it's showing you this delta through a candlestick format. This is great for building context to price action. So how I like to use this is I will view both of these as two things that have to complement each other. I'll look at volume, I'll look at delta, and I'll look at price action, and I'll start telling myself a story. Okay, price is going up. Then we developed a bull flag or whatever you want to call it. We developed that low. We developed a low. And then we broke below the low. At the same time, Delta did all those same things. But as Delta made the new high right there, you can see price, let me clean that up a little. Price right here broke its prior low. Delta held its prior low. There's something in here that's a red flag, right? It's a divergence between these two tools. This tells you whether this can tell you whether or not there's a possibility of a fake breakout going on. Large participants, they understand that markets are a competitive place. It's a battle between buyers and sellers. So a lot of times what they will do is they will lay traps for the opposing player. So essentially, I want you to think of this as like a treasure chest, or how would I describe this? Like a bunch of inventory that they have. I think I used like ammo, right? How much ammo does the seller have? How much ammo does the buyer have? You can represent that through these candlesticks. And if the seller's ammo, aka the seller's level on CVD, is not being taken out, but on the price it's being taken out, if the buyer's level is not being taken out on CVD, but it is being taken out on um, the candlestick, all of a sudden your brain should be telling you there's a divergence here. Something is wrong. There's a red flag, right? The buyers have not been taken out purely in buying versus selling, but they did get taken out in price action. Is this a clear sign to me that um, this short will continue? It's actually a sign to me that this is a weak breakout. So that's how I view it. Again, another sign you could see right here, this pink arrow. As price breaks, we're breaking these structures. So it paints you a whole picture. And then, yep, price continues to go up. You can see a retest of that zone, right? There's divergences here, but this is a positive retest of the delta. So you can see in this context, a delta divergence is a positive sign, right? You can see how I'm applying two different contexts to it. And when you're playing pullbacks, it's a healthy sign that that area is being held. Okay, so here's some examples of CVD. This is from today, I believe. So again, this is price, and this is CVD bars. Price action is showing us that there's a breakout, but CVD is telling us a different story. So right here, we have this little consolidation happen. Let me change the color on that. All right, right here we have a little consolidation happening, right? Just a little 1 minute consolidation, and then we get a breakout of that consolidation, right? How can you decipher whether or not this is a quality breakout or not in that moment? Well, if you look at CVD, CVD is not breaking out. This is weak. This is a weak sauce attempt from buyers in CVD, but on the candlestick, which can be deceptive, it's looking like a breakout. So right away, divergence. When you're seeing divergence, you want to start thinking trap. There's something going on that is probably trying to trick me. You want to use both of these together to find confluence. So when there is confluence, that is a sign of continuation, right? And then when there is divergence, that's a sign of a trap. You want to use CVD to view buying and selling as inventory, aka ammo. You want to. This is how I like to think of it in my brain, and maybe this will help some of you resonate to it. I view this and I'm thinking, okay, I view markets as a battle, right? Whenever there's a consolidation, there's a battle between buyers and sellers going on right here. As this battle is happening in price action, I'm looking at it in CVD and I'm thinking, well, who's winning the battle here? Do the sellers who have been controlling this, do they look like they're in trouble in terms of actual volume, in terms of actual delta? Are they in trouble? Are buyers putting up a good fight? Nope, doesn't look like it. So that's a sign for me to continue with my downward bias. Okay, here's an example of absorption. Absorption again, go all the way back, is passive liquidity overwhelming the market liquidity. So again, bookmap, passive liquidity, right? Now, I want you to think of this as an area where, for some reason, whatever reason, uh, there's a higher time frame level here, value area, but we won't get into that. There's large participants that want to be buying here. So their passive liquidity, smart money, their passive liquidity is sitting here saying, everyone who wants to play a breakout trade, go for it and give me your shares. I'll buy them all. They're absorbing all of it. It's kind of like Pac-Man. They're eating all of the little ghost things, whatever they're called, and um, they're absorbing all the pressure before they go up. So this is a level, and how I'm seeing this absorption without a footprint is you can see that CVD is making new lows, but price action is not. There is your divergence. Why is CVD making new lows? Well, CVD is market orders. It's showing you delta. And delta can be high, or in this scenario it's low, like it's dropping, which is high delta for sellers. Delta is going down, delta is heavy. However, price is not going down with it. That's a good sign of absorption to me. Great sign. There's a divergence. So when you start seeing things like that, it starts cluing you into, okay, maybe it's now time to stop looking for downtrends, start looking for reversals, and then you can apply things like naked trading and all these concepts to it. Specifically this trade, I took it myself. I believe this was this Monday, this trade. You can play here. There's your breakout. You're playing the continuation. Yeah, so when you're seeing absorption, you want to start thinking of looking for reversal patterns. So pair this with naked trading. Here's the trade. So we're seeing the absorption right there, that absorption right there, and then I just played it long for the breakout continuation. So you're seeing you don't even necessarily need to get in at the absorption. This is just contextual information of what's going on, and then you can build a picture of how the market will flow, right? And I love using naked trading, so I play relative to that. Okay. Oh, okay, and I put a bonus example. I actually forgot I put this. Um, I know lots of you love the Fibonacci golden zone ratio, the 50% and the 61.8% retracements. So I looked at the order flow, the absorption, um, at one of these setups. This is a screenshot from, it's almost a month ago. I posted it in the trade screenshot tab. So I just pulled it and put it in here, but we can go through it of what's going on here. So maybe you guys who trade this setup can apply that and see how we're framing this contextual information to the golden ratio strategy. So you draw your pivot, and then as price pulls back into it, a pullback in its nature is at the time of pulling in bullish. So as price is moving up right here, that's this, and then it hits the key level. Again, key level is always important. Hits the key level, which is the 50% in this scenario. You can see a bunch of buying coming in right here. That's great. I mean, buying is great, right? As long as there's continuation. But we get a bunch of buying right here at the level but no continuation. Actually, the next candle is a red one with selling at the lows. Then the next candle is a trap. Then we get some more buying at the highs and no follow through again, right? Wherever you want to enter this trade and how tight you want to get, that's kind of up to you and the system you define. But this order flow allows you to see the context of they're getting trapped and then they're having to sell. They're getting trapped and then they're having to sell. And eventually, as they make the new lows, there's the press down. So you can very clearly see the operation of absorption. There's passive liquidity sitting right here, who's absorbing all of this up, and then you take it down. Okay, the do's and don'ts of order flow. Like order flow and futures is getting very popular, and rightfully so. They're great tools, and it's a great system, and all this. But there are some things, and these are, my personal takeaways, of course, that I've observed, and here are my opinions around it. The do's of order flow is you do want to trade this stuff with a clear idea of market structure. You could use just Wyckoff theory, auction theory, like I have this diagram here. Apply that to, like, are we breaking out and then retesting, that type of stuff. Apply that to apply order flow to that stuff. It works great, tremendous. And order flow works best at clear inflections. This right here, the middle of this range, this is not an inflection. This is the middle of a range. And in the middle of a range, as is the nature of ranges, it's a mess. There's a bunch of buying, there's a bunch of selling, there's a bunch of everything going on in the middle. Trying to decipher this information in the middle will drive you crazy. Trust me, I've done it. There's a lot of traps, there's a lot of balance. It's in the nature of ranges that in the middle is where the chum, the liquidity, the the little fish sit, and at the extremes, at the inflections, is where the best risk to reward and the best signals or context of order flow sits. So do trade with the structure, do trade at inflection points, do not chase every print. With order flow, everything, if you start looking at it in the wrong spots, everything looks like a signal. And that will drive your brain crazy. You want to only look at this stuff at inflections. I'm not staring at my order flow until it's at key levels or doing key things. AKA, it's not in the middle of a range. So don't chase every print, don't diddle in the middle, and do not trade. Well, I put footprints, but you could just put order flow. Do not trade order flow without an underlying strategy. This is the cherry on top. It is not the sundae itself. You want clear risk management. You want clear entry and exit criteria, stop criteria. You want a strategy that is profitable through the strategy, the candle structure, whatever you're using itself. And then you want to apply order flow to allow you to increase your win rate. And if you're already a winning trader, I can say this for myself. I started applying order flow to my trading well after I was already making money in markets. What order flow allowed me to do is increase my win rate by 5 or 6%. And for a winning trader, this 5 or 6% jump is huge at the end of the month. So order flow is the cherry on top. I'm not going to draw a sundae, but it's the cherry on top. It's designed to increase your win rate and help you decipher between higher and lower quality trade. It's not the trade itself. And yeah, okay, perfect. Yeah, before we start the Q&A, I just want to again reiterate that although there's a bunch of different styles of viewing order flow, it is the exact same information, no matter which framework you use. So the most important slide of today is this one. This will help you get an understanding of what's going on and build the contextual picture. Whichever tool you use is up to you. You have to find what works best for you, and the only way to do that is through some trial and error, through some back testing, some forward testing. If you are going to start applying order flow concepts, I would recommend not trading them right away. Put them on your screen and observe it. Trade your normal style, but just observe the order flow on top of it. Don't make execution decisions based on order flow for a couple of weeks until you've actually seen it, grown comfortable with it, etc., etc. Because it can be deceptive if you don't know what you're looking at. All right. If anyone has any questions, I'm here. Sweet. Oh, and I before I end the recording, I want to talk about the tools or the programs that I find best for order flow. Um, TradingView is solid, but it is not the most ideal for order flow. However, it has the tools, so go for it. I use Sierra charts. Um, this is like the top of the line order flow, everything futures trading program, but frankly, the learning curve for this is extremely high. So, be careful if you want to dive into it. Ninja Trader is phenomenal. Ninja is great. There's another one called Go Charting. That's a G. Go Charting.com. It's web based. So just like TradingView, I believe it has like very similar UI. Has all these order flow tools on it. So mess around. You'll be able to find which tool, whatever tool you're looking for on most of these programs. If you're not able to find it, you need some help configuring your tools or whatnot, just shoot me a message. I'm in the Discord all the time, and I'll definitely help you through it. See, there's a question from Andrea. Hi, Andrea. Great presentation, Zach. Thanks a lot. My question is, what is the name of the tools indicator in TradingView? Okay, so in TradingView, it is called uh, just like the footprint chart. And then the delta profile one, I'm not too sure what it's called in TradingView, uh, as I don't use TradingView, but this screenshot right here is from TradingView. So it is available there. I'm sure if you just search delta profile, you'll be able to find it. I can take a look later and post it in the Discord for the exact name, but I wouldn't know right now just because I don't actively use TradingView. There's one called cumulative. Yes, that is CVD bars, most likely. So these bars, yeah. So um, if if that's the one you're looking for, yes. And I know TradingView has it, so. No worries, no worries. Okay, I'll stop the recording here.